Hi, good morning, everyone. My name is Gerald, and welcome to another session of today's Morning Kappa at 8. What I will do is I will provide an update on the Singapore market. Okay, so over the past week, we saw Singapore stocks reaching a record high. We now have the Singapore's benchmark Straits Times Index at 4,261 points, with a 1.7% gain in the past week. And what we see here is that the Singapore market has outperformed some of the US indices, such as the S&P 500 and the Nasdaq index. Okay, so this is the chart that we see for the benchmark Straits Times Index. Effectively, after the sell down in April with the US tariffs announcement, we see that it has rebounded very strongly with close to a 30% gain since then. And that is partly driven by a few factors, including the easing of the US trade tensions. We also have the Singapore market being seen as a safe haven amidst all of this global uncertainty. At the same time, we also have some country-specific drivers. So in this case, we have the Singapore Monetary Authority of Singapore introducing various measures to revitalize the Singapore market. So just in the past week alone, we saw some additional measures that were introduced, such as the 5 billion equity market development program to strengthen the local fund management ecosystem. So in this case, what was announced last week is that three fund managers have been selected, and they will be allocated 1.1 billion Singapore dollars to invest in the Singapore market. So that is driving a renewed interest in Singapore stocks and helping to bring the Singapore benchmark STI to a all-time high. The other point that is worth noting is that the Singapore bond yields have fallen very sharply. This is the 10-year government bond yield. And what we see here is that it has fallen to close to 2%, given the once again safe haven status of Singapore and the increasing demand for Singapore government bonds. So one question that we commonly get is what are the sectors that will benefit with the lower bond yields and still trading at attractive valuation compared to the historical average. So here we have the Singapore REIT sector. We see here that it has rebounded slightly with the lower 10-year government bond yields, but effectively still trading at lower levels compared to, say, 2 years or 3 years ago. Okay, if I were to look at the fundamentals of the REIT sector across different property sectors within the Singapore market, we also have the second quarter figures that were just announced in the past week. Here we see that the retail rental index continues to be very strong with a 0.9% gain over the previous quarter. And this improvement is seen across both within central region as well as outside the central region. Okay, next we see the office sector. The office sector has been slightly weaker compared to, say, the retail sector, where the rents actually fell by 0.3% quarter on quarter. And we also have the vacancy rate across the different office sectors having different performance. Last but not least, if we look at the industrial sector, this is where we also have it being one of the more resilient subsectors, with the overall industrial property rental index up by 0.7% in the second quarter compared to the previous quarter. So all in, what we see is that different REIT subsectors have different performances in the second quarter, and that's also driving the divergent performance amongst the Singapore REITs. We have selected REITs that are up as much as 45% year to date. We also have certain REITs that are down by more than 20%. Okay, so different REITs depending on the individual subsectors that they're in, depending on their balance sheet strength, we see that they actually have got fairly divergent performances. So at this point in time, if I were to look at the price to book valuation of the Singapore REITs, once again, we have REITs that are trading at fairly depressed valuation at less than 0.2 times price to book. We also have some of the REITs, such as the healthcare REIT, the data center REITs that are trading at above book valuation. So the question that some investors might have would be, are there still opportunities in Singapore REITs, and how do I identify some of these opportunities? So at this point in time, if I look at the average of the 40 S-REITs and property trusts in Singapore, they offer an average dividend yield of about 6.8%, which is above the dividend yield of the benchmark STI index, as well as the 10-year government bond yield. So with the spread that there is present, it may appear attractive to some investors. And if I was to look at the different REIT subsectors, we have the industrial REITs offering an average dividend yield of 7.1%. And then if I look at the retail REITs, the average dividend yield is at about 6.2%. Okay, for investors that do not want to select individual REITs, we can look at REIT ETFs, which offer you exposure to the REIT sector in a diversified way. So with a single trade, you can get exposure towards a basket of REITs. They are lower cost compared to actively managed funds, and they are also professionally managed at the same time, where the ETF manager will help with the rebalancing of the REIT. Okay, so if I were to look at some of the more popular REIT ETFs in the Singapore market, they actually offer a dividend yield of close to 6%. And with this REIT ETFs, they offer you exposure towards the REIT sector that I described above. So with that, I'll end my sharing on the Singapore market. Overall, we see that the Singapore market is now at an all-time high. The bond yields are coming down, but we still have some sectors that are trading below the historical average, including Singapore REIT sector. And I introduced the REIT ETFs as a way to gain exposure towards the Singapore REIT sector in a simple way. Thank you so much for the session today, and I hope to provide you with more updates in future sessions. Thank you.
Right. Thanks, Gerald. Okay, morning, everyone. Welcome to Morning Kappa. Aiman here. Right. So if you look at the S&P 500, so the index has resorted to sideways yesterday, so inching up by only 1 point to close at 6389 points. So the index now is at the lower channel and have potential to rebound further up. So we believe that the sentiment is now neutral, well, at least for now, as investors are waiting for the Fed's move on the rate announcement this Thursday. Also, if you remember, last week, Trump announced that US and EU has agreed on the 15% tariff. Well, technically, if looking at the charts, there is still a chance for the index to retrace slightly before it could potentially went up to test the 6,500 resistance level. Right, so looking at our US trading stocks that we have published overnight yesterday, we have DoorDash. So the stock is eyeing to break out at $250 level on the strengthening trading volume. So if the bullish momentum to hike further, we can expect to test the next resistance at $265 level before it could climb higher towards the $280 level. So now that if the momentum to reverse and form a lower low, make sure to have stop loss at $230 level, as it could indicate a possible change of trend. And up next we have Upstart USD. So if you can see here that the stock has climbed higher and break out above the 80 US dollar level. So looking at the market structure right now, we believe that it is now the best time to ride the trend. Now, if the price continue to break higher, it could potentially to test or to touch the 90 US dollar resistance level, followed by 100 US dollar level. So also a reverse below 70 US dollar level will open the door for a deeper correction. So looking at the Hang Seng Index futures, so the index recouped some of the losses yesterday, gaining 143 points to close at 25,545 points. So the index now is trending higher to hit the immediate resistance at 26,000 in the coming session. So the overall of the Hong Kong market are now in positive sentiment as it continues to reach a higher high. Well, if you remember, US and China are resuming its trade talk negotiation on extending the tariff truce, somehow give a breather to the China market. And also the talk will continue on Tuesday. Right, so to look at the charts right now, we keep our positive bias unchanged. We expect the market to see uh, it reach the 26,000 level if the bullish momentum to follow through in the coming session. And if any pullback to happen, we expect the market to retrace towards the 25,000 psychological level. Right, moving on to the WTI crude oil price. So it has recouped the losses in the previous session, and now it seems like it is currently trading sideways above the 64 US dollar support level. Well, in terms of sentiment, we believe that the oil market is positive at the current juncture. Also, on side note, just to share with all of you, Saudi announces that they might hike the September oil price for Asia for the second straight month on robust demand but tight supply. So if the sentiment to experience the same, we might see that the WTI crude oil price to hike higher. Also, for now, we expect that the market to at least remain steady at the current price. We maintain our positive view on the WTI crude oil price. All right. So tonight, let's join the second half market outlook presentation by Lex at 8 to 9 p.m. This night. So do register if you still haven't registered yet. Right. Okay. So coming back to Malaysia, looking at the FLI here. So it has resorted to sideways, remain still in the consolidation zone. So the index yesterday only at 0.5 points to close at 1532 points. So we believe sentiment for now at least remains neutral as investors are waiting for any further outcome from the uh, Malaysia and US negotiation on the tariff that has been increased to 25%. So from what we understand, Malaysia is now eyeing for tariff to be lowered below 25%, but within 20% range. Also, this is justifiable by the cumulative net fund flow month to date. You can see it here. Foreign flows are in net sell position. Right. So if you look at our watch list for today, we have highlighted some of the counters that may experience or will experience a bullish breakout in near term. So we have Winstar, MN, EcoShop, KGP that caught our eye. Right. So tonight, we have a second half market outlook presentation by Alex at 8 to 9 p.m. So do register and tune in. So we have our Malaysia trading stocks for today. We have Technovision. So the stock has experienced a bullish breakout above the 205 cents, supported by the trading volume. So we expect the momentum to sustain and climb further to test the next resistance at 215 cents, followed by 225 cents. So if it happened to break up below the 195 cents and form a new lower low, this could indicate that the near term to go back. Also, next we have EcoVest. So the stock has a breakout above the 42 cent with a long bullish candlestick showing that this bullish setup is strengthening. So should the momentum to hold in the coming session, the counter could potentially testing the next resistance at 46 cent, followed by 48 cent level. Uh, so if it dropped below 40 cent level, this would open the door for further correction phase. Right, so looking at the FCPO here, the commodity underwent a follow through bearish momentum from the previous session, losing the bull creep to slit by 31 ringgit to close at 4242 ringgit. So we still maintain our positive uh, market sentiment for this CPO, holding our positive view on the CPO market. So also recently the MPOB's outlook on the CPO market remains positive, riding on the strong demand as it expects the export to recover in second half of this year. However, looking at the broader technical setup, bullish still remains intact. We view that the current pullback is just a healthy correction within an uptrend trend. So we continue to hold our resistance at 4,400 to attract the price in the coming session. All right, so I think that's all from me. I'll pass the floor to UJ for his EcoShop update. Thanks, everyone.
Okay, morning everyone. We have workshop FY25 results today, and I'll be presenting on behalf of myself. We are still keeping our buy call and target price of 451 cents. EcoShop FY25 results were above our expectation. Core net profit of 214 million ringgit met 105% of our full year forecast due to stronger than expected GP margin expansion. Year-on-year, FY25 revenue jumped 16%, underpinned by 74 new net store opening, and the same-store sales growth was flattish at negative 0.4%. On a positive note, the price increase expanded FY25 GP margin by 1.8 percentage point to 28.2%, which more than offset the rise in OPEX stemming from higher minimum wage. And correspondingly, FY25 core net profit surged 17% to 240 million ringgit. Looking at Q-on-Q, fourth quarter revenue dipped 6% after volume decline in reaction to the price increase, and consequently, fourth quarter core profit fell 9% as GP margin expansion was insufficient to offset the top line weakness and higher OPEX. In terms of outlook, EcoShop is focused on opening at least 17 new outlets per annum in order to penetrate into underserved markets and consolidate its market leadership in the dollar store industry. Meanwhile, it recently launched targeted marketing campaigns to drive footfalls and same-store sales growth by leveraging on the elevated GP margin. And on top of that, EcoShop's participation in the Sumbangan Asas Ramah program could be another effective lever to lift footfall. in order to lift foot traffic. Post-result, we make no material changes to our earnings forecast. Our DCF target price remains at 151 cents, which implies 31 times 2026 PE. All in, we're still keeping our buy call. We foresee the dollar store industry to continue the rapid growth by capitalizing on consumer downtrading trends, thanks to the wide value for money product offering. And with this, EcoShop offers earnings visibility and at the same time, robust earnings growth fostered by outlet expansion plan to extend its dominant market share. That's all from me. I'll pass on to Meng for his presentation. Thank you.
Thank you, Eugene. So we are looking at a Guan Chong report. This is a company update. Basically, I think Bloomberg reported that European cocoa grinding have declined for 4 consecutive quarters, at about -5% year-on-year. And the Malaysian grinding also fell 22% year-on-year in the second quarter of 2025. I think these reflects the changes in product formulations, reduce pack size, as well as a substitution with alternative ingredients amid elevated bean prices and ongoing tariff uncertainties. These changes on the chocolate product, coupled with lower cocoa butter ratio, have changes the dynamic and have tightened the supply of cocoa powder, which remains expensive. But all this fails to incentivize higher grindings due to the substantial working capital requirements, as well as volatile market conditions. Consequently, we expect the Guan Chong overall utilization rate in the second half to ease to 85 to 90% level, as its US customers, which make up 15% of its revenue, continue to adopt a wait-and-see approach on tariff uncertainties. Now, on a positive note, these reductions in production could improve working capital efficiency and cash flow. Management has also observed an improving sales trend at a more moderate bean price recently, and they expect a pickup in spot buying closer to the seasonal peak seasons into the late third quarter and early fourth quarter. In terms of margins, we expect that to remain very resilient, as the previous forward selling of the ingredients will achieve at a healthy combined ratio. Now, while the cocoa butter ratio have declined from 6 months ago due to improved bean availability and tariff-induced cautious, they remain elevated relative to historical norms. Importantly, this will be offset by higher powder ratio, a discounted bean price differential compared to a premium last year. In terms of the bean price, I think we are looking at a discount to the terminal price compared to a premium to the terminal price last year, which will help to reduce the input costs. Now, a potential return to a contango market structure after taking into account the bean discount versus last year backwardation cocoa market structure will also help to improve margins. Now, the last bit of the point will be on lower interest rate. I think these will also help in terms of the overall profitability. Now, overall, we expect a stronger Q&Q into second quarter, as we believe the healthy combined ratio realized in the first quarter of 2025 are expected to sustain into the second quarter before normalizing in FY26, a scenario which already reflected in our forecast. Now, we revised lower our FY25 to FY27 earnings forecast by 13 to 14%. This is after taking into account lower utilization rate as well as the higher interest cost assumptions. Our target price is now revised to 2 ringgit and 58 cents. It was 3 ringgit post bonus issue adjustment, pegged to an unchanged 15 times FY26 PE. Now, yes, we believe at current price, is trading at a very undemanding 6 to 7 times an FY26 PE, which is very attractive for its multiple growth drivers, which include capacity expansions in the UK, as well as Ivory Coast Phase 2 and its JV with the Ivory Coast government. Despite the expectations of the slowing global demand and softer cocoa butter price, we believe Guangzhou's recent share price correction is overdone, considering the prospect of a potential record high earnings in FY25 still. Maintain buying, new target price RM2 at 58 cents. I think that's all from us today. Thank you so much for joining us. We hope to see you again tomorrow.